This is FinTech Insider News. This week, Curve and Infact partner to improve financial inclusivity, the FCA wants to make home buying easier for Brits, and Americans lost $12.5 billion to scams last year. We'll be discussing all of this and more on today's show, so don't go anywhere.
This episode is brought to you by Audi. The road is calling. Embrace the thrill of the drive with the all-new, fully electric Audi Q6 e-tron. Featuring effortless power, serious acceleration, and advanced Audi tech. It's not just a new EV, it's a new way to experience driving. The all-new, fully electric Audi Q6 e-tron is here. The next chapter of Audi starts now.
Hello and welcome to episode 945 of FinTech Insider. The Formula One season roared into action this weekend, and FinTech is firmly in the race, with no fewer than 19 FS companies sponsoring teams this year. I have to say, as an F1 fan, I'm kind of happy that FinTech has replaced tobacco over the years, because it mostly just used to be kind of like Marlboro and West and all that, for those of you F1 geeks out there. Anyway, if you can name them all, well, answers on a postcard. And lining up on the FinTech Insider grid today, we have a panel of FinTech experts ready to navigate the latest twists and turns in financial services and FinTech news. So first up on this week's pod, we have a warm return to the show for Valentina, Kristensen, Corporate Affairs Director at OakNorth. Great to see you, Val. How are you and how are things going at OakNorth?
Very well, thanks. It's great to be back on the show, and there's lots to cover. I'm excited.
Absolutely. And next up, it's a FinTech Insider debut for Will Mason, CEO of Infact. Great to have you with us, Will. You have some exciting news, which we'll get to shortly. But first, please tell us a little bit about yourself and Infact.
Yeah, thanks, David. Very happy to be here. I'm Will Mason, co-founder, CEO of Infact. We are a challenger credit reference agency. We help lenders make affordability and credit risk decisions on largely underserved customers.
Brilliant. Great to have you. And last but not least, we have a welcome back to the show for James Dodsworth, Senior Manager of Financial Crime at Thistle Initiatives. Great to have you back on the show, James. Please remind our listeners about yourself and what you do at Thistle.
Thank you. Thank you for having me back. It's good to be here. So yes, I'm a Senior Manager at Thistle Initiatives. It's a regulatory compliance consultancy. We work with a whole range of financial institutions and payment service firms, amongst others. And I work in the anti-financial crime team there. So I lead up the anti-fraud and sanctions services.
Amazing. So we have a panel, and now on to the news. And our top story this week, this one is from FinTech Finance. Curve and Infact partner to bolster financial inclusivity through real-time credit reporting. Curve and Infact have announced a new partnership to introduce real-time credit reporting, a major shift from the outdated 30 to 90-day update cycles of traditional credit bureaus. Both companies see the innovation as crucial for financial inclusivity, as nearly 20 million Britons face financial vulnerability, and outdated credit reports often lead to declined applications or a reliance on unregulated lenders. So Curve Flex customers will now have their credit data updated instantly, helping them build accurate credit profiles while allowing lenders to make better informed decisions. So, Will, first off, congrats on the partnership with Curve. This is amazing news. What more can you tell our listeners about this?
It's been a long time in the making with them. We've known the guys at Curve for a very long time. And Rob in particular, who joined recently to head up their lending practice, used to run an open banking credit card where we had a sort of slight misalignment in terms of the mission. But as soon as he joined Curve, I think we were probably its first call. And we helped them with a combination of services in how they make better risk affordability-based decisions. But they completely bought into the nature of real-time credit information sharing for the benefits of themselves and their customers. Happy to dig into the detail in terms of how we do that, what we do. I think it's important to note from our side that whilst we're moving the industry towards real-time API-based credit reporting, we do obviously still have a fair amount of legacy in financial services. And so we still work with the legacy data formats, those kind of 30-day plus reporting cycles. But every single client that we work with is engaged on moving towards real-time credit reporting. And we manage them through that process, helping to show them the benefit of the uplift for both themselves and their customers as we take them on that journey.
Go for it, Val.
Yeah, I was just wondering because I mean, looking more into Infact, and obviously, as you say, it's there's the real time data, but it also seems like you're using different or alternative sources of data. So things like buy now, pay later, which obviously, less than a decade ago was not a thing, and so that's not something that, as you say, in legacy providers will be factored. I mean, are there any others like rental payments is one that I know has been on, been on many platforms pipeline. So just wondering what other kind of alternative data sources you look at.
Yeah, thanks, Val. I mean, the point of becoming a credit bureau was that we enable lenders to look at alternative information in the context of data that they understand. So capturing the historic credit performance and being able to evidence the uplift that you can get from alternative data in a reliable, responsible, trusted way is part of the story. And part of the reason that we are both going after the traditional credit reporting data that you would share with Experian, Equifax and TransUnion, but also layering in that alternative information. The other benefit that we get from API-based reporting in a modern credit bureau is that we're able to allow lenders to reflect the product in our system as they designed it and as their consumers understand it, rather than based on the historical nature of mainframe-based credit information, mortgages or a fixed term unsecured loan or something like that. And so when you're looking at a buy now, pay later product where the customer goes out and buys 2 pairs of shoes with the intent to return one that's the wrong size, we're able to both reflect the shape of that product accurately and in real time. And then when the refund happens or the return happens for that second pair of shoes, the amount can be updated in real time rather than sit 100% over what it should be in the traditional credit report for 30 to 60 days.
Right. And I think actually in what you've just said is a nice kind of 101 on what it is. It is literally real time as you're capturing the data on the lending decision. You are then reporting it into the credit bureau.
Yeah, and it's more than that in that we can do performance data in real time as well. So as the events happen with their customers, they can report it into us in real time to make sure that the balance is accurate. The customer doesn't look overutilized. And that's important for a number of reasons. So new lending reported in real time, it's great for consumers in building their credit profile. It's also great for the lender in making sure that anyone who is then about to lend to them knows that this event has just happened. And so they can take into account the level of indebtedness of the customer as it is at that particular point in time. But then as they're paying it off and their utilization of debt goes down, lenders are able to see that this customer has actually got a lower level of utilization than they might be able to see on the traditional credit bureaus, and so could extend additional credit to them. And in that, the increasingly kind of transactional nature of financial services, where consumers are using buy now, pay later or other products as a proxy or an alternative to the traditional credit card, those transactions are just happening much faster and are more complicated for lenders to get a real risk read on.
So it sounds like there are some real clear benefits for customers. I mean, there's this really interesting stat here which shows that something like 1 in 3 consumers who check their credit files discover errors. Will, what are the kind of typical types of errors you tend to stumble across that customers find?
Yeah, I mean, it's timeliness, the outdatedness of information is one of the critical ones, which is obviously what we're trying to solve through this real-time reporting system. Mismatching of data, because we don't have the concept of social security number in the UK, so we have to create identities around the pieces of information that lenders share with us. So mismatching of data is always problematic. Delays in payment statuses being updated. So again, it's kind of a timeliness point as well. And then force-fitting accounts into existing accounts, which creates this inaccuracy and probability of default models. And then consumers always have a problem with some of the more public data that also exists on credit reports, like the electoral register is often outdated and can cause significant problems for customers. But the impact of those errors is either someone gets accepted for credit where they've got an adverse financial event happening in one of the accounts that the bureau is not matching to or hasn't got visibility on, or they don't get access to credit because they look thin file or overutilized, or something else is going wrong in their credit report that means they get declined for financial services that they should be accepted for.
Val?
I also read that, about 15 to 20% of credit files have preventable formatting errors. So, again, a lot of this is manual. You're talking about legacy systems. So someone's literally like, maybe they've put in a comma in the wrong place and now it looks like there's an extra zero, or they've put in a wrong date. I think that just things like that. And I've moved a few times over the years. The electoral register is something that's super frustrating because I think it's updated depending on which borough you live in. It's like, twice a year. So you're not even talking about like 90 days. It could be, months, like several months that it's out of date. So I do think that it's obviously a real game changer for a lot of customers. Even those that might have perfectly good credit scores, I think, a lot of banks will now give you access to your credit score, but you don't see your full credit report. And I would really, it's not financial advice, but I would always say to my friends, it's worth just paying to kind of do a quick look and see what's on your report, because you'll be amazed at how many things might be captured incorrectly. And also sometimes, you can identify potential fraud that's happening, which actually happened to me when I
definitely
when I was on maternity leave. Unfortunately, I had plenty of time to then go after the fraudster. But it's obviously very, very common. And I think, I've certainly found that it's worth paying for to kind of get full access to the report and be able to make sure that the information is accurate.
Oh, absolutely. That's actually a good segue, Val, to bring you, James, into the conversation. I'm guessing there is a strong anti-fraud component to being more real-time and therefore being maybe more compliant to regulations.
Yes, certainly. There'd be a number of benefits to that, exactly for some of the reasons Val was just saying. I think the more you can make people aware and give them access to information, the more chance they have they can spot something that's unusual or they're just not considered before. So I think adding that real-time element there is going to be really beneficial in a number of respects. However, the cynical side of me also suggests, how could this be gamed in some way? It would be interesting, as fraudsters never stand still, if they could understand how this real-time process works, whether they could front-load potential amounts or other options in order to try and trick the real-time process. I'm not suggesting that's possible at all, but with these guys out there, you never know.
Yeah. Well, we'll talk about fin crime and some of the developments in it later with the FTC stuff, but something that we're very conscious subject.
That's very interesting. And Val, is there an SME component to this as well? I'm just thinking about your sort of OakNorth hat. Is it SME credit moving to real time in any way?
Potentially, in the sense, I know that most buy now pay later don't really use they say they don't really use your credit score, or it doesn't impact your credit score using them. I suppose, though, for the vendors or from the SMEs that are selling to customers, potentially having a clearer picture of the creditworthiness of the business, of the individuals that they're offering this credit to, would be helpful. And certainly for the providers of buy now pay later, like the Klarnas of the world, I could imagine that would be helpful for them too.
No, absolutely. Well, just sort of the final word on this one. Where does this go from here? I suppose both from a Curve partnership point of view, but also from a real-time streaming point of view. What's almost next?
Yeah, we don't just work with buy now pay laters. We work with digital unsecured lenders, monoline credit card providers, retail finance, and then the buy now pay laters of the world. So we're increasingly getting more complete coverage of the UK population, and helping lenders make better risk-based decisions on their customers. So in some instances, we're seeing a reduction in the cost of credit for consumers because those lenders are being able to make more effective credit risk decisions about the customer. In some instances, in affordability, for instance, we're seeing a fairly significant amount of growth in some of the portfolios that we work with, just by providing more information about the customer at the point that the application is made. And that's because the data and affordability is relatively raw at the moment. Long-term users of open banking, but our business doesn't have anything to do with open banking at this stage. And so we're helping bring more affordability data earlier up the application journey to then help lenders triage into open banking later on, or just pass through from a straight accept perspective. It can and will go in many, many different directions, to the point that has been made on fraud, collections, debt servicing advice, all sorts of different areas that we'll start to move into, and hopefully beyond financial services at some point as well.
Awesome. One to watch. All right. And now on to our next story. And this one is from FinTech Magazine. Marqeta and Spendesk FS partner to enhance expense controls. Marqeta and Spendesk have teamed up to enhance payment services for over 4,000 small and medium-sized businesses across Europe, with Marqeta becoming the issuer processor for Spendesk Financial Services. The partnership will enable real-time transaction monitoring and spend controls, giving finance teams better visibility over company expenses while ensuring compliance with financial policies. Spendesk will leverage Marqeta's technology to issue both physical and virtual payment cards, allowing businesses to set spending limits, restrict merchants, and authorize transactions instantly. So, to find out more about the partnership, we spoke to Marcin Glogowski, SVP, Managing Director for Europe and UK CEO at Marqeta.
Expense management is a very dynamic space, and Spendesk is standing out in this space as a company being able to solve for true pain points of medium-sized companies related to monitoring budgets, customized spend controls, and overall helping to boost efficiencies of those companies. We have been working together to offer and bring card processing at scale, both for virtual and physical cards, and also to support high level of customization working at scale. And we are just very, very proud to be partner of Spendesk and jointly grow our business together.
Awesome. Val, I want to come to you first. So what do you make of this one?
Yeah, I mean, I think this is all part of Marqeta's sort of European expansion. They've obviously been forging a lot of partnerships with fintechs in particular. I mean, that's kind of how they've stood out from the Stripes, the Adyens, the Solarises of the world. We partnered with them at OakNorth last year in terms of providing cards to our business banking customers. And I mean, look, this partnership will give them access to, I think, over 4,000 more SMEs across Europe. So it's all sort of part of that strategic expansion for them. And I think, I mean, obviously from the SME's perspective, we know that expense management is one of the things that's incredibly tricky, whether they're looking to apply for a loan or whether they're looking to manage their cash flow. So, the ability to get again, going back to, I guess, seems to be the word of the day, but real time. And I think, Spendesk uses a lot of AI and API integration as well to try to get that real-time data and give customers a very smooth experience. So I thought this sounded great, and I mean, we've had a very positive experience with Marqeta in the sort of 6 months or so that we've been working with them.
And I mean, this is it's interesting because this is the second partnership kind of news item on the roster this week, and it seems that strategic partnerships are kind of more and more the way to go to market. Val, is that what you see as well, and I guess in the SME sector or more broadly?
Yeah, I definitely think so. I mean, I think it's just sort of, I guess, the fintech way. It's, historically it might have been that you'd go to one provider for everything, and that was seen as the best way to do things. Obviously, many of us have now built our tech stacks from scratch. I mean, we're on, I think, our 4th iteration at OakNorth now, in terms of using different providers, because what's considered best in class isn't necessarily, I mean, we're going to be 10 years old in September. So what was considered best in class a decade ago might not be the best in class today. So we're constantly sort of, looking at different providers and seeing what makes sense. And I think from our perspective, we've certainly found that that's how you build, a much more resilient tech stack as well, right? So that you're not fully dependent on one provider, because if something happens, as we've seen with many of the bank outages that have happened in recent months, recent weeks even, that can cause a real issue. So I think it's these sorts of partnerships, they'll continue, especially, fintechs working with each other.
And Will, how do you see partnerships? So Curve, this is your first major partnership announcement, is that right? I mean, is it kind of a model for how you're going to market moving forward?
Yeah, I mean, it has to be for us. We partner with, we think about everyone that we work with as partners. It's our first major announcement, though, for sure. And as a bureau, we have to partner. They give us the data that allows us to do what we do, and we provide the API back out that allows them to do what they do. So it is a natural partnership. I think the main thing that we see is that we just have to find someone with an aligned vision and a somewhat aligned goal, and then just develop mutual trust with each other. And everything else can sort of fall into place after that if you've got trust and a shared vision. We definitely found that with the Curve team, but we found it with a lot of the other digital lenders in the market as well.
I guess you're learning from these providers as well. I mean, I just want to pick up on something Val said about the kind of the pace of change almost. Val, you were saying kind of 4 iterations in 10 years. How do you think about that, Will, as a kind of a new young fintech startup, looking at things like Gen AI and agentic and all of that kind of stuff, and then just the sort of rapidity of having to keep code up to date?
Yeah, I mean, I think we made 460 odd releases last year. So we're constantly iterating, like it's daily that we make changes and push them to the production system. We're very careful, obviously, about how we do it. I guess the AI topic in my industry in particular, Val, to a certain extent in yours, is complicated. We're starting to see the FCA and the ICO wrap their arms around it with Nikhil, CEOs of both those organizations, calling roundtable in May to start thinking about how AI can really be used in banking and financial services, but in credit scoring in particular, it's very complicated. And so we stay ahead of it, we stay close to it, we make sure we're ready for it when it's kind of ready for us. But certainly we don't pin ourselves to any particular technology in what we do from a day-to-day basis, no.
Yeah, cool. James, just going back to the story about the partnership. I mean, how do you see kind of regulators looking at partnerships like this? Are they facilitating them? Are they helping them? Do they say, actually, hang on a minute, there's exchanges of data here. This is something we need to be concerned about?
Well, some working in the financial crime area, data is obviously important, and the one thing that I want to see is probably the opposite direction of travel, in that there is more data sharing, particularly in relation to fraud instances where it's perfectly legitimate for institutions to be doing that. And if anything, we want to encourage that, and I'm sure we'll talk about that a bit later as well. I think when it comes to regulators, it depends on what hat they're wearing that time in the morning. Generally, if something's gone wrong, then they'll raise a concern, but otherwise they tend to sit there and see how it's all going to shake out. And to me, I think a lot of these partnerships are obviously highly strategic and make a lot of sense. And long may they continue, as long as there's a benefit to the industry as a whole. And some of the things we've seen here, we've got 2 instances of real-time movement towards real-time transactions and monitoring. To me, can only be a good thing, because it means more data, and if there's more data, it can be analysed better.
Awesome. And on that note, we're just going to take a quick pause here. Back shortly.
Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alica Bank, who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
This episode is brought to you by Indeed. When your computer breaks, you don't wait for it to magically start working again. You fix the problem. So why wait to hire the people your company desperately needs? Use Indeed's sponsored jobs to hire top talent fast. And even better, you only pay for results. There's no need to wait. Speed up your hiring with a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Welcome back. Before we get back to the show, we wanted to tell you about our latest Insights episode. Gen AI has the potential to disrupt everything, as we've kind of been talking a little bit about here. And financial services might be just the tip of the iceberg. I am joined by some great guests from Instabase, Clio, and the FCA, that's right, the regulator, for a check-in on how Gen AI is transforming not just our industry, but all industries. It's out now. Just head to the podcast below this one. Right, back to the news. And our next story this one is from FinTech Finance. The FCA sets out to support home ownership. The Financial Conduct Authority wants lenders to be more flexible and offer first-time buyers greater access to mortgage deals in the UK. When lenders decide whether to approve a mortgage, they test whether a borrower could still afford their mortgage at a higher interest rate. As interest rates fall, the current market approach to interest rate stress testing may be unduly restricting access to otherwise affordable mortgages. The FCA wants to ensure firms are aware of the flexibility its rules provide, and the creditworthy customers can access the affordable mortgage they need, supporting home ownership. So this is super interesting, right? Because I guess there's loads of pros for the customers, but there's also some potential pitfalls here as well around sort of relaxing attitudes towards credit, I guess, in some cases. Val?
Yeah, I mean, I think the timing of this is just really interesting. Obviously, we've got a huge motor finance PPI level scandal happening with lenders that have been sort of pulled into that, sort of saying it's, I think I heard one lender sort of say it's like you're driving down the motorway where the speed limit is let's say 50. And then, 2 months later, the speed limit is changed to 40, and then you get a speeding ticket because you were driving 50, but the rule at the time was 50. And this is how many lenders feel that the regulation has changed sort of after the fact, and now they're, facing millions of pounds in fines. So I think it's an interesting timing from the regulators to then be saying, there is flexibility. You should be looking at, how to kind of relax, certain rules, because I don't think appetite from lenders right now will be particularly high for many lenders, especially those that are caught up in the motor finance scandal. And if they are lending to motor finance, if they are providing motor finance, they're probably providing mortgages too. They certainly obviously are providing credit for B2C credit. So, yeah, not great timing, I would say.
Yeah, I'm not saying that the FCA is in any way political, but there is a political angle to this, in that, the Chancellor and the Labour government in general is really encouraging people to get on the property ladder, and it's, sort of part of the plan to kickstart the economy in the UK. So I suppose it would be beneficial to get more people to own homes. James, what's your view on this?
Yeah, it's an interesting one, isn't it? I mean, we think back historically to 2007, 2008 mortgage crisis originating in the US and all of the bad debt related to that and the ongoing issues that's caused. But then you couple it with the attitudes to the UK market and how we think about home ownership as well. It's quite different from a number of other countries. I certainly agree with you in that there's a prompt here to try and encourage more home ownership and everything that's related to that. This approach by the FCA is an interesting one, I think, and I would agree with Val to an extent on some of the attitudes coming from the lenders may be a lot more conservative than what the FCA are hoping for, particularly such volatility in interest rates as they are anyway. I mean, who knows what could happen in the next 6 months to a year.
But I also think it is a very this sort of idea of home ownership is obviously quite a British thing. Yes, compared to the rest of Europe, it's like, I think 63% of Europeans or European countries, there's like 60% home ownership across Europe. And in places like Romania, Hungary, Poland, that's very high, sort of like 80, 90% plus. But in places like Germany and France, it's sort of like between 40 and 50%. So I think the UK is actually pretty good. But it's also because, the mortgage market is very different here, right? Typically, you've got a fixed rate for 2 to 5 years. In places like Denmark, where I'm from, it's not unheard of to have, up to 30 years, which obviously just gives buyers a lot more stability. So I think it's just a very different market, and there's just a very different attitude towards home ownership versus countries like Germany or Switzerland or France, which typically have very strong rental markets.
Yeah. On top of the fact that it is so expensive to buy property in the first place, and unless we build more, it's going to keep on getting more and more expensive. I suppose this is partially what the FCA is anticipating here, is that price pressure isn't going to ease up anytime soon at all unless we start building. So actually, really, what we need to do is just allow people to buy houses at that higher price.
But the funny thing is we've actually built a lot. We haven't built as much as we wanted to, but there's a bottleneck in regulation in terms of property. So the building safety regulator that was created post the after the Building Safety Act, following the Grenfell tragedy, I mean, it's sort of been pretty widely written on. They've got a huge backlog of property developers that are sort of stuck in different gateways. There's 3 different gateways, and it's across the UK. We're talking about literally tens of thousands of homes that are ready for people to move into, but they don't have this tick box of being safe, so people can't move into them. So there's problems not just in terms of actually developing, but even just getting people to move into those homes is a real issue once they are built.
And there's also the other, back with my financial crime hat on, there's a whole swathe of properties that we keep hearing about that are just, no one's in them. They've been purchased up by foreign investors. The percentages in London are meant to be huge, and there's some properties that haven't been lived in for 20 years. Surely some activity in relation to reclaiming those and reconstituting those back into the market would help as well.
Well, I'd like to come to you also, because I suppose there's a credit bureau, credit decisioning angle to this as well, and how the banks are, coming up with that decision to lend. Interesting to get your perspective.
Yeah, for sure. I mean, it's just there's a few different sides to this for them. To Val's point, they won't want to take a risk on something that's potentially going to be the next PPI or motor finance scandal in a few years. They will be very wary of interest rates going up, but they're also facing into problems in terms of getting approvals to change anything. If you build an affordability stress test into your decision system or your decision process, it's very, very difficult to do all of the analysis that says it's okay to change that, take it through governance, and then implement it. Like you guys at 11FS live in the weeds of COBOL systems and trying to transform these banks. It's very, very hard to do it. So it's not just everyone thinks the future is rosy, let's change the stress testing rules. There's a whole implementation program that would have to happen around it. And I actually think, just in terms of the pace the FCA and the government are looking at this, if they really do want to stimulate growth, in particular through housing and building houses and all of this stuff, they need to go faster. Like in all of these instances, we just see the regulators not responding at the speed the market is responding to. And we would love to see some pace injected into this program as well as many others. I'll leave it there.
All right. No, it was a very good discussion. Very interesting to see whether any banks take up the FCA on their rather precarious offer to relax some of these rules. And we're going to now move on to the next article, and this one comes from TechCrunch. FTC says Americans lost $12.5 billion to scams last year. So that's from things like social media, AI, and crypto didn't help. According to the US Federal Trade Commission, FTC, about 2.6 million people submitted reports on falling victim to fraud in 2024, totaling $12.5 billion in losses. So that's a big jump from 2.5 billion lost in 2023 when the FTC received roughly the same number of reports. So the most common way that people lost money was through imposter scams, where bad actors pretend to be romantic interests, family members in distress, government entities, or technical support experts. And they were most commonly contacted by bad actors via social media. Bank transfers were the most common way people sent money to bad actors, totaling around $2 billion. But cryptocurrency payments weren't far behind at all at $1.4 billion. James, is this going to get worse before it gets better? Is it ever going to get better, or is it just going to keep getting worse?
You may by now have realised that I'm a slightly cynical person working in fraud and financial crime. And I'm afraid I don't see any rosy outcomes in the near future from this. Even if we take the US specifically, this is a financial market that is somewhat different from the rest of the world, certainly the EU, in terms of the payment systems and the way they look at things. I mean, look how long it took them to get chip and PIN, for instance. And a large amount of fraud in the US is still related to check fraud, which is something that's all but passed over here as the fraudsters have moved on to use of the technology and all the lovely platforms that we've given them access to. So certainly for the US, I don't see this getting any better. I think the spike here in numbers from the previous year is probably just the start of an increase as the fraudsters really establish how they can attack this rather large market. And we've seen in other areas, particularly like the UK, where it's more mature, the fraud levels have relatively stayed the same. They're still very high, but we think about the authorised push payment mandatory reimbursement scheme coming in October. Everyone was expecting a big spike in amounts there, and it's stayed relatively the same. It's not to say it hasn't gone away, it's just moved into other ways. Compromised card has become a big thing again, as it was, say, 10 years ago. And the other point here is that I still see this as a tip of an iceberg. An awful lot of frauds just don't get reported at all, either through embarrassment or they're just not being discovered. I think the NCA in the UK says that around 87% of frauds go unreported. 87%, that's incredibly high. And we know here in the UK that fraud itself makes up 40% of all crime. That's every crime you can think of, and 40% of that is fraud. It's a huge number, and there's only 1% of police resources allocated to it. So I'm going to be cynical and say this is probably going to get worse before it gets better.
I mean, I think related to that, it's part of it, and I think that stood out to me for this story was the age ranges, right? That I think that it sort of said that there's more people aged between 20 and 29 who lose money more often than those aged 70 or more. And you can kind of see how, those aged 70 or more, might not necessarily appreciate that they've even been the victim of fraudulent activity. Those aged 20 to 29, as you say, might just sort of have a degree of embarrassment about reporting it. So, yeah, I think there's, that was very interesting to me because I kind of think there's this perception that it's only going to impact people who are much older, who might not necessarily, who might be a bit more vulnerable. The fact that it's 20 to 29-year-olds as the sort of largest demographic, even if they're losing smaller sums of money versus those age 70 plus. But that just shows you the role that social media is playing, right? Because a lot of this is happening on platforms like TikTok and Facebook, YouTube, and they all have sort of policies in place, and they say, we take down sort of fraudulent videos, but there's no way that they're taking them down as quickly as they're going up. And obviously with, businesses like Meta sort of starting to reduce the amount of time and resource and people that they have looking at this kind of content, you can imagine that it's probably not going to go in the right direction going forward.
God, it's terrifying. What do you think, Will?
Yeah, I think we could just do a huge amount more to educate people on financial education. Has been spoken about forever and ever by earnest people trying to do the right thing. And it's never been done particularly well yet. I mean, the same platforms that a lot of this fraud is happening through have a great chance to engage people of a younger demographic about the risks and the opportunities associated with financial services. But I never really understood why we got rid of it in the education system as well. We used to learn about how to run a household budget, and it's gone. You used to learn how to cook. You don't learn how to cook anymore. And so all of these things just wrap up into like, what are we doing to help younger people really enter adult life beyond teaching them maths? Which, like, I can ask an AI to do maths now. So
that is true. I mean, we need to look at the way that society has changed to an extent, and also the way that we interact with finances. This is something I'm quite passionate about as well. I mean, I have 2 children, and the concept of real money is something that is disappearing. It's all electronic transfers of money. That's all they see. They don't really understand the value of having a tenner in your back pocket anymore. It's just not something that happens. And I think to Val's point around the lowering age of the demographics is related to exactly to that, to the social media, of course, but also the perceived ability to get rich quick, whether that's through crypto, meme tokens and all these other grab and dash things that are popping up. The world's changing, and we just keep up with it. And I completely agree with you, Will. I mean, the education piece is crucial. It's completely missing at the moment, and we need to educate people and understand their finances and how they've been approached to talk about them.
You're both right. I mean, we used to know, right, in the analog world, what we could and couldn't do. You don't put your wallet on the table. You put your hand over when you're typing in your PIN on the ATM, right? But it feels like we've lost those skills for the digital world. Val?
Yeah, I mean, I think, if you think about when you are making a bank transfer in any one of your apps, there's probably like 3 or 4 different prompts at different points that are like, is this person real? Have you checked that it's not a scam? Have you verified these details and so on? So you have to you're almost like frustrated, but you're like, oh my God, I just want to send like the £15 or whatever, before I don't want to sort of have to click a million different things. There is, I think, potential for social media platforms to look at introducing things like that, right? It could be, certainly if you're sort of having conversations with people, I mean, it could be like a pop-up, it could be, something in the messenger, the messenger part of the platform, which sort of is a reminder. Because I think, even if you give people the education, the training, sometimes it's just those kind of, you just need something, you need to tell someone something several times before it actually sinks in. And I think if someone had that, that prompt right before they did something, like when you're in your bank, app, you might be, you might just have a, think twice and just double check before you do something.
I think there's an element of a lack of accountability in respect of them having to do that at the moment that is causing some divide, and it's something that the banks, financial institutions are thinking about at the moment. It's, well, why are we the last line, currently the first and last line against all of these scams, when, as you say, Val, they are originating predominantly on social media, or they're originating on social media to get you off platforms onto things like WhatsApp and other encrypted devices where no one can see what's happening between you and the fraudster. But there's no reason for them to really do otherwise. Again, the cynical side of me suggests that they're still getting paid for advertising rates and other bits and pieces through some of these services. True, still a business. And certainly with the political changes in the US as well, that some of the talk around maybe a fraud levy against social media firms and telecommunication firms as well, because obviously a lot of this has come through mobile phones, it seems to be walking away at the moment because of the threat of pulling out some of these major companies from the UK markets as well.
I also think a lot of it's also being a fraud has actually been glamorized, right? I mean, you've got like the Netflix shows, the Tinder swindler, Inventing Anna. I mean, there's a whole category now basically on it. And you can see these people who get away, with having sort of 18 months in prison. They then have a book deal, they have a Netflix show. So there's actually, from the fraudster's perspective, it's almost like, great, I could get away with doing all of this and then potentially having, very limited personal repercussions. And then even if I end up losing all the money, well, I'll get it in the form of a book deal or something else, right? I mean, I guess Wolf of Wall Street would be one of the bigger, larger scale versions. But as I say, there's always kind of been this glamorization of fraudsters and sort of making them seem like almost kind of celebrities, which is also something that's changed dramatically.
That's a really interesting point, and I guess I'm guilty of that to an extent, because Catch Me If You Can is one of my favourite films, which you could suggest is glamorising someone who's turned from being a serial fraudster to working with the US government, and still continues to do so. But there's another side to this as well in relation to things you say there, Val, around accountability, and I think people's responsibility of their own finances appears to have changed as well. There's a survey that suggested that 45% of shoppers in the UK admitted to a return fraud or abusing a return policy. That is, that they bought something, or they returned it, or they said they didn't receive something and claim the money back, what have you. 27% of those people justified it by saying, well, it was just a large retailer. What difference is it going to make to their bottom line? And then 14% of them said that they did it as revenge for poor customer service. So, attitudes have changed somewhat, and it could be perceived that banks are the be-all and end-all to protecting your finances, when I still believe that people have a personal responsibility over looking after their own finances and being sure of what's happening in their account, not giving their account details away, all these other bits and pieces as well. So there is definitely a sea change there.
I just want to pick up on what you said, the personal responsibility thing, because put this out there. Are we simply in a kind of interstitial transition period between analog and digital? We're in this kind of world at the moment where, yes, people have forgotten skills from the analog world. We're adapting to this new hyper-digital world. But ultimately, there will be a learning that people will then figure out how to look at the right kind of links, figure out, where the accurate source of communication comes from a bank or not. And that over time, people will, to some extent, adapt. I mean, I suppose they have to, right? They have to learn.
They do, but you would expect the people to have learned the fastest to be the younger demographic who appear to be the worst off from this. But you probably don't click on a dodgy link or go through some sort of dodgy process because of what you're doing. But these younger people have just lived in social media their entire life, and they're still being caught out by this. So that I agree, David. There's a transition period, and everyone will learn more about it. But it feels like that learning hasn't happened in the people you would have expected it to happen in.
Yeah, absolutely. And I just want to end this conversation by reading another stat as well about the sources of scams. So, people looking for jobs and business opportunities, which is big now, nearly tripling in number of reports between 2020 and 2024, from $90 million in losses due to this method up to $500 million in losses. I mean, it's just phenomenal. I'm also, by the way, super happy we got through that conversation without talking about Gen AI. So that was amazing. All right. And now for a quick look at one more news story this week that we don't have time to cover in full. And speaking of generative AI, this one is from FinTech Finance. Nubank elevates customer experiences with OpenAI. Nubank serves over 114 million customers in Brazil, Mexico, and Colombia. Nubank aims to enhance both customer experiences and internal efficiency with solutions developed with OpenAI, including internal search. So this provides employees with instant access to company insights, driving smarter, faster decisions. Call Center Copilot empowers human agents with conversation summaries and recommended answers, increasing customer satisfaction and reducing time spent on each ticket. AI-powered assistant resolves 55% of Tier 1 inquiries, handling over 2 million monthly chats and reducing chat response times by 70%. And fraud quality assurance, I think this is a big one, uses GPT-4o Vision to analyze transactions and documents, streamlining fraud detection and delivering high quality of service. I think the conversation here is really shifting from, there will never be a world where Gen AI has a place within banking to actually it does have a very, very, very firm place in banking as the technology gets clearer, gets more auditable, gets more open source. Nubank is a great logo. It's a really interesting bank, but they aren't the only one. There's BBVA. They're also a big logo looking at it. BNY, to name just a few. There's so many more. So it'll be interesting to see how we get more and more clear statistics from banks, because that's really what it comes down to. How is it saving money? How is it benefiting customers? And how is it remaining compliant? So I definitely think we're only right at the beginning of this. Cool. And finally, and this one is from The Independent, Nationwide gives 12.3 million customers an early Easter gift. Nationwide is giving £50 to all of its 12.3 million customers as a thank you for their support during the Virgin Money merger, which saw them become the country's second largest provider of mortgages and savings. That's very interesting. I didn't know that. This gesture of more than £600 million is called the Big Nationwide Thank You, and it represents an astonishing dividend for a large proportion of the nation. The payments are due to land from 9th of April until the 14th of May and will go to members who had a savings or a current account or mortgage at the end of September 2024. They must also have made at least one transaction or had a balance of at least £100 in their accounts. So Nationwide spent £2.9 billion on the takeover, but also they have gained £2.3 billion since its completion. I'm not a Nationwide customer. That sounds great. Any Nationwide customers here? James, 50 quid.
Yes. So I did a bit of a test here before we record this. Now let's speak to my wife about this, and told her that there's going to be £50 coming from Nationwide. And her first question was why. So the reason behind it had been completely missed at that stage. Her second question was, do we get two lots because there's two of us? So, straight from my wife, she went from having no interest to can we double it in the space of about a minute. So yeah, it's an interesting one, this. I mean, obviously I kept a keen eye on what was happening with Virgin Money, having been a customer of them in the past as well, and some of their longer term history as well is quite interesting. I don't really know what to make of this. £50 isn't going to change the world. Might give me a couple of pints down the pub maybe, but apart from that.
I think more specifically, I mean, our producer has kindly put in some things you can buy here, James. So you can buy a multi-pack of 48 cream eggs. You'll still have some change left over. Or you could put it towards a giant 4-kilo milk chocolate egg from Not on the High Street, retailing at £225. So no, you can't buy that at all, can you? No. You can buy a bit of it. But it is interesting. I mean, it might also negate some of the negative feelings towards the Virgin Money takeover. I know sometimes these things do result in some negativity. I suppose there was some controversy, I think, when IG acquired Free Trade with some of the original crowdfunding, investors didn't get all of the credit they certainly felt that they would do. I mean, there's some interesting news about that online. What does everyone else think?
I also don't know what to think about it. Does giving people cash create more loyalty? Does it help people that annoyed about the Virgin Money deal? I'm not 100% sure. What I am really interested in, though, is given it's such a broad range of customers and how much money it is, can you measure it in the macro? Because in April, we've got a bunch of bills going up in energy, water, car tax, TV licensing, various other things. And it's going to hide the data. So we're going to have to wait another month to see what actually happens with cost of living, which makes my life complicated. So we're going to have to try and figure out how to factor it into affordability models. But
I mean, I think the thing is, it also depends on the how, I guess, the loyalty of these customers and sort of how price sensitive they are, because I'm sure many would prefer just to have a higher rate of interest rather than, or at least a rate of interest that reflects what's happening with the Bank of England base rate. Rather than getting, a random £50, around Easter. So I think it's, and also I guess the fact is that a lot of their customers, I'm going to assume, don't celebrate Easter. So there's also there's a potentially there. They might say, well, why are you giving it to us now and not some other time of the year? But I think, many customers will just sort of say, well, we'd rather just see a better interest rate. And I guess to Will's point, given all the things that they're going to see in terms of cost increases in the months ahead, that will probably move the needle more for those customers than a random £50 towards an Easter egg.
Yeah, 100%. I agree with that. Actually, and I was just looking into what the controversy actually was. So with the takeover, Virgin Money members were given a vote on the deal, but Nationwide members were not. So I guess this is a way of saying, sorry, thank you. I don't know.
See, the cynical side of me again. This is all going straight into marketing. This is full on. Will's alluded to this already. This is full on. Look, if you come to us, you might get a random £50 every now and then.
Love it. Yeah,
I do think there's something with Nationwide that they've always been such a good bank. It's like, do they really need to give someone £50? People don't leave them because they haven't given them £50. They provide an amazing service. So, yeah, I'm surprised they've done it. I don't think they need to. It's better for Cadbury's than for consumers.
Absolutely. And on that wonderful note, that wraps up this week's FinTech Insider News. So thank you so much to today's guests. Where can people find out a little bit more about you and your companies? Val?
Yeah, so you can drop me a message on LinkedIn, Valentina Kristensen, or check out OakNorth at www.oaknorth.com.
And Will?
You can find our company at Infact.io, and you can find me on LinkedIn, Will Mason.
James?
You can find me on LinkedIn, talking about all things fraud, and you can also find me at thistleInitiatives.co.uk.
Awesome. And as for me, you can find me on LinkedIn, and do check out that podcast on generative AI. It was a really, really cool discussion. Thank you so much for listening to today's FinTech Insider. If you like what you heard, please make sure to follow us on your favorite podcast platform of choice. And if you really like what you've heard, why not share the podcast with a colleague or friend? Go for it. As always, if you want to join the conversation, find us on social media. Just search for 11FS or FinTech Insider, or email podcasts@11fs.com. Thanks again, and goodbye.
Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alicabank, who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.